So the mortgage market is about to go through the biggest phase shift it's seen in over a decade, and almost nobody watching this video is actually ready for it. See, while most buyers are waiting for the Fed to cut interest rates, the smartest buyers are making moves right now that nobody's talking about. Because the second mortgage rates touch 6%, the National Association of Realtors estimates 5.5 million qualified buyers flood back into the housing market all at once. And that's the largest pent-up housing demand in modern history, which means the moment those buyers re-enter, bidding wars come back and the price you've been waiting for evaporates overnight. But there's a small group of buyers I'm working with right now who are positioning for this exact moment, and they're gonna walk away with the cleanest deals while everybody loses twice, once on the bidding war and once the price spike that follows. If we haven't met yet, my name is Francisco. I've closed over 400 loans and approved over 200 million in financing for everyone from first-time home buyers to self-employed investors that every other lender turned down. And I'm gonna walk you through exactly why waiting for the rate drop is the most expensive mistake you can make in this cycle. 5-step playbook the smartest buyers are running to get positioned before the cut, and why your bank is the last place you should be getting your mortgage right now, even if they've already approved you. So let's actually look at what's happening in the market right now. Now, the market is already telling you exactly where this is heading, because a year ago, the 30-year fixed was sitting at a 6.83%. Today, we're around a 6.3, and it's dropped every single week of April from 6.46 to 6.37 down to where we are right now, which is a clear downward trajectory. And it isn't happening because the Fed already cut. It's because they actually haven't cut yet. The federal funds target is sitting at 3.5 to 3.75%. Exactly where it's been since the last cut. So the rate movement we're seeing right now is just the bond market pricing in cuts that haven't actually happened yet, because lenders, they're anticipating. And what they're anticipating is the data, because March CPI came in at 3.3%, which is re-accelerated inflation from where we were 6 months ago. Energy was up 12.5%. year over year, and core CPI is sitting at around 2.6. Unemployment at 4.3% with 178,000 jobs added in March. That mix is exactly the cocktail that the Fed has been forecasting for one cut in 2026. And they're being patient, with Powell meeting again on April 29th and the market pricing in at basically zero chance of a cut that meeting. The question is what happens to the housing market the moment they do, and whether you're going to be one of the buyers ready to move or one of the buyers competing with everyone else who finally woke up. Now, 64% of buyers are already delaying their purchase, and 94% of them say they won't pull the trigger until rates drop below 6%. And honestly, this is exactly where every single one of them is making the wrong call. Because when they actually run the numbers, waiting for that rate drop is gonna cost you way more money than it saves you. On a $400,000 loan, for instance, the current 30-year fixed at 6.3% puts your monthly principal and interest at around $2,500 a month. If rates drop tomorrow to 5.80%, that same loan drops to around $2,350, which gives you a roughly savings of $150 a month, or around $1,550 a year. Except the second rates hit 6%, you have 5.5 million qualified buyers flooding back into a market where inventory is already constrained, especially in places like Florida and Texas, where the supply situation is already tight. On top of that, NAR is forecasting a 14% jump in existing home sales in 2026. And that surge isn't spread evenly across the year, but it's stacked into the months right after the cut. So every buyer who is waiting on the sidelines all shows up the same week, and they're all bidding on the exact same houses, the ones that you're looking at. And when that happens, bidding wars, they come back, sellers stop accepting contingencies, and prices spike almost overnight. So if the home you were looking at went up by just 5%, which is honestly just conservative for this market, with this much pent-up demand, that $400,000 house is suddenly $420,000, which means even at the lower new 5.80 rate, your monthly payment ends up at around $24.64 a month. So you've just gave back almost the entire savings of that price alone, and you needed an extra $4,000 in cash for the down payment just to get to the closing table. And that's at a 5% price spike, with the actual response easily hitting 8 or 10% in tighter markets. So you do the math the way most buyers do. You wait, you save $1,500 a year on the rate, which feels like a win, but then you pay $20,000 more for the house, and you're competing against 5.5 million people who all woke up the same week and decided it was time to buy. The buyers walking away with the cleanest deals are already sitting on a fully underwritten file right now, so that the day that the Fed moves, they can lock their rate and write an offer by that afternoon. For example, I have a buyer who was able to secure a property way under market value in Loxahatchee, Florida. Loxahatchee is an area west of West Palm Beach, which is blown up because of the pent-up demand in South Florida. Loxahatchee was being used by a bunch of first-time home buyers who were looking for land and wanted properties at a good price. Because the rates have gone up, most of the buyers who were looking in these areas decided they should wait and they should see what happens with the market. Now, the smart buyers, like my client, decided this was the perfect time. He got a higher interest rate than most of the people who had bought back in 2022, but he was able to secure a property almost $100,000 below market value because he didn't care. What he did was he got a second mortgage on his property at a higher interest rate and was able to use those funds to buy a property with another type of loan that has a bit of a higher rate and secure a property in Loxahatchee, waiting for the moment when the demand comes back and people go crazy over the big lands. Because he got a bit of a higher rate, he was actually able to get a lower price on the property, and he knows that the moment that the rates come back down, we can qualify him with a conventional loan and take advantage of a lower interest rate through a refinance. Because he has so much equity in the property, even if he wants to take money back out and remodel this property, build a pool or whatever, he took advantage of the market, which is the most intelligent move to make in real estate. As they say, don't wait to buy real estate. Buy real estate and wait. So what does it actually mean to be pre-positioned? Because most people watching this think they already are. They walked into their bank, had a 10-minute conversation with a loan officer who pulled their credit and asked about their income, and they got a letter the next day saying they were pre-approved up to a certain number. But that isn't actually a pre-approval. What most people call a pre-approval is really just a pre-qualification. And in this market, sellers, they know the difference. A real pre-approval means your file has been fully underwritten before you even start looking at houses. Your income is verified, your assets are confirmed, your credit is analyzed, and an actual underwriter has signed off on your file. And that's a fundamentally different document than a pre-qual letter from a bank. But there's a second part to this that almost no buyer thinks about, which is who's doing the underwriting and what products they actually have access to. Because if your pre-approval comes from a bank, you're getting underwritten against the conventional products on that bank's shelf, and that's it. So if your income type doesn't fit a clean W-2 box, you're either getting denied or you're getting a much worse rate than you actually should. And honestly, most of the buyers I'm seeing right now are not clean W-2 employees. They're business owners, 1099 contractors, self-employed professionals, or investors living off of rental income. And banks aren't built to underwrite any of them cleanly. So the bank looks at all of that and just says no. But that no isn't actually about you. It's just that one product that bank is licensed to sell. I had a client who recently owned a $5 million property on Fisher Island, owed $3.5 million on it, and wanted $1.5 million cash out refi. But two other lenders had already turned her down, including the same bank that we ended up using, because she had $124,000 a month in foreign deposits from the Dominican Republic showing up on her bank statements. So we switched her from a bank statement loan to a P&L loan, and her CPA certified her income, her expenses, and we were able to bypass the foreign deposits issue completely. We closed the $1.5 million loan at only a quarter point above the standard bank statement loan rate. Or for a TikTok influencer making over $1 million a year through TikTok Shop and a few other payment platforms, his broker had already told him to wait and save up more money before he could actually buy. We got him into a 12-month bank statement loan with 10% down payment, no tax returns required, and closed in 15 days with appraisal and everything. So that's what non-QM, P&L, bank statement, and DSCR loan products can do when you actually shop with a broker who knows how to shop across all of them. Your file closes when the market shifts instead of falling apart when you actually need it to work. And by the way, if you want us to actually look at your file before the next FOMC meeting and tell you exactly what you qualify for, I'll leave a link in the description below where you can book a consultation with our team of experts. Now, the buyers I'm positioning are all running the same 5-step sequence in the exact same order, and skipping any single one of these steps means the day the Fed actually cuts, your file is back in the scrambling pile with everybody else. So step 1 is pulling your credit and looking at it the way the lender will, which means the actual middle FICO score across the 3 bureaus, not the score you see on Credit Karma. Because the gap between a 680 and a 740 on a $400,000 loan can be 1/4 to 0.5% on your interest rate, which over 30 years turns into tens of thousands of dollars of interest. So if there's anything fixable on your credit report, you want 6 months of lead time to fix it before you're writing offers. Step 2 is structuring your DTI. Now, DTI stands for debt to income ratio. And what most buyers miss is that lenders, they don't look at what you actually pay, but at the minimum payments on your credit report. So if you have a $10,000 credit card balance with a $200 minimum payment, that $200 is what counts against your DTI every month, even if you're paying the balance in full every single time, which means consolidating, paying down, or restructuring revolving debt 6 months out can dramatically expand what you actually qualify for. Step 3 is getting fully underwritten. And I mean actually underwritten, not pre-qualified. And the key to doing this right is timing, because you want this done before you start looking at houses, not after you've fallen in love with one. The underwriting process itself is what most buyers skip over because it's more work than a 10-minute phone call. You're submitting full tax returns or a P&L statement or bank statements, asset documentation, and letting the underwriter verify every single number on your file against the actual source documents. And once that's done, your pre-approval carries actual weight because every single number on it has already been verified by an underwriter. Now, that matters because a real closing, that letter is the exact thing that gets scrutinized, and a pre-qual that was never verified can fall apart under that pressure. When sellers have multiple offers in front of them, they are evaluating certainty instead of price. So your offer becomes the one the seller trusts, and that's the leverage that actually wins you the house when the market tightens. Step 4 is locking in a rate watch alert with a broker who's going to move on your file the second the macro shifts, because rates, they don't wait for you to make a decision. And when the Fed actually cuts, the best rates get taken by the buyers who already had their file ready to lock. A rate watch alert is your broker actively watching the 10-year treasury yield and the Fed signals every morning and reaching out to you the second something moves that changes what you can lock at. And when that moment hits, you want to already have your documents submitted and your application sitting on the desk, ready for the lock. The goal is having the file on your desk, your broker's number in your phone, and the ability to lock the rate in a single phone call. That gets you the lower rate the same week the Fed actually moves, before the bond market has a chance to digest the news and reprice it back up. Because after a cut, rates usually overshoot down for a few days and then correct back up as the market digests what the Fed actually did. So the buyers who lock in those first few days are the ones who actually capture the bottom of the cycle before the correction actually kicks in. And step 5 is being ready to write an offer the same day the deal hits, which means you have an agent on standby, your inspection contacts lined up, and you already know your numbers and the neighborhoods you're willing to compete in. Having your agent on standby means they know that you're actively searching and you've already talked through how you handle multiple offer situations, what your ceiling is, and when you're willing to escalate. On the inspection side, you've already got a licensed inspector whose number you can text at 8 in the morning and have him to the property 5 p.m. that same day. And you've already run the comps across the neighborhoods you want to compete in. So when a house hits, you can write an offer with conviction the same day it goes live. Because the best deals in a recovering market sell within hours of hitting the MLS, which means that speed is the entire game at that stage. And when a property comes on the market in the neighborhood you've been watching, there's almost always other buyers who have been watching it for just as long as you have. But the buyer who can move in 24 hours is the one who actually lands the contract, because speed itself becomes the leverage that wins the deal. Now, if you're self-employed or 1099 or running your own business, your version of this playbook looks slightly different because you're working through a P&L loan or a bank statement loan, which means your accountant is preparing 12 months of income documentation in a format the lender will actually accept. So that conversation needs to start 6 to 9 months before it actually needed, because 12 months of clean income documentation needs real time to prepare properly. If you're an investor and you're looking for pre-positioning for a DSCR loan, running the rental income against the debt service and getting comfortable with that 7-something rate that sometimes is normal for a non-QM, so when the right deal hits, you're lined up to close in 30 days. The reason this whole thing is so time sensitive is that the macro setup we're in right now does not last forever. The Fed is holding rates because inflation reaccelerated and the labor market is softening, but not weak enough to force a quick easing cycle yet. But every month that we get further into 2026, the data is going to start telling a clearer story, and eventually that story is going to push the Fed to act. And when they do, the market reaction is gonna happen fast. We've already seen the bond market start pricing in cuts, which is why we went from a 6.46 to a 6.3% in just over 2 weeks. That move is going to accelerate the moment the actual cut happens, because every lender in the country is going to be repositioning at that for the same exact time. The buyer's position for that moment already did the work months ago. Their credit is pooled, their DTI is clean, their file is fully underwritten, and their broker is sitting on speed dial. So the second that rates touch the number they were waiting for, they lock that same afternoon. Everybody else is going to be opening their banking app on a Tuesday morning, seeing a Fed announcement, and trying to figure out where to even start. And by the time they do, 5.5 million people just woke up and beat them to it. So that brings me to the actual question. What does your file look like right now? And what's your cleanest path to being one of those pre-positioned buyers? Because every file is different. Whether you are a W-2 employee with a clean income history, a self-employed business owner who's been writing off everything, or an investor scaling a rental portfolio, or somebody coming back from a credit hit, the playbook is the same, but the execution looks completely different from file to file. And getting it wrong, even by one product or one structural decision, costs you tens of thousands of dollars and locks you out of the cleanest path to closing. So if you want someone to actually map your file against the whole market and you show the cleanest path, that's exactly what we do inside Vantage Mortgage. The first thing we do when a file comes is we pull your 3 numbers and run them across every single lender we work with. What we show you right after is that the gap between what you've been quoted somewhere else and what you should actually be paying. Then we map out your structuring play for the next 6 to 12 months, so when the macro actually shifts, you're already in a position to close. We've done this on every pre-approval we've issued with nearly 100% close rate, because when we say you're approved, your file closes. So if you want to see what your file actually looks like before the next FOMC meeting hits, I'll leave a link in the description below where you can book a free consultation. And I'll see you in the next one.